Good morning, everyone. I am the Executive Director of the Oregon Bioscience Association. My name is Lisa Bozinovich. Thank you for joining us this morning at our Bio Business and Good Beans Zoom Coffee Talk. In this time of COVID-19, info is rapidly changing, and so is the speed of business. And our Bio Business and Good Beans Zoom Coffee Talk was created to help keep you updated with the most relevant topics of the day. These fast-track, touch-based sessions are designed around key topics to help bio-business, academic institutions, and our supporting organizations. If you or your company would like to be a part of a future session and have some content that you think would be relevant, do let us know. And you can check out topics for next week and beyond at oregonbio.org, where you can also learn more about our upcoming classes and our BioPro training certificate programs. And if you want to see some of our past programming, if you go to our oregonbio.org/events and click on our signature events page, you can see a link there to some past recordings of the Bio Business and Beans sessions. Today's program is being recorded and will be available on our social media channels and on our website and that signature events page for as long as the content is relevant. We've invited an expert from the CPA firm DeLapp to help distill the nuances of the PPP payback provisions today. That's a tongue twister there, PPP payback provisions. Before we get started, we want to thank our sponsors today. Their support makes our programming possible, and we couldn't do it without them. So big thank you to CAI, Nikon, Skanska, Summit Development Group, and VWR. Now, it's my pleasure to introduce our speaker for today's session, entitled What Companies Need to Know About PPP Loan Payback Charges. We're joined by expert Harriet Struthers, a certified public accountant with DeLapp. Harriet has nearly 40 years of experience in providing state and local tax advisory and compliance services to large multi-state and multinational companies. With extensive experience managing tax compliance and audits for all areas of state taxation, as well as IRS, LMSB, large case audits. Harriet also performs state and local due diligence related to mergers and acquisitions. And Harriet's become an expert recently in the CARES Act and all of its provisions, which has created the PPP. So I just want to quickly review how the session is going to run. Harriet's going to go through her presentation. For questions, please use Zoom's Q&A feature and feel free to upload your questions during the presentation. We've saved time at the end to go through them. And if you've got a burning question that you feel like you want to get answered during the presentation, Harriet's agreed to take questions as we go. So feel free to just use the raise hand, the virtual hand raise feature that Zoom has available for you. And if you leave today's session and find you have unanswered questions, you can email them to us at news@oregonbio.org, and we'll put that into the chat. And we'll work with Harriet and her team at DeLapp to get you those answers. We've got until 10 o'clock today, and so we'll try to end right on time. With that, I'm going to let Harriet take it away.
All right, let's make sure I share the right screen. Always a good idea. There you go. I think I got the right one. Thanks for coming today. And, you know, as you just heard, somebody had to become an expert in the Paycheck Protection Program and the CARES Act. And it's one of those things that should go away quickly. We don't expect it to be around for that long. So we've limited our team for real in-depth answers to just 3 of us. And with me today, we have Joe Sullivan, who's actually your representative from DeLapp. Joe is very well versed in the Paycheck Protection Program, but he will often defer on the more complex and more detailed to myself and my team, which includes 2 others, my partner Dave DeLapp and Kyle Reynolds, who is a senior manager on the assurance side. You have both of our contact information here, and we're happy to answer any questions that you might have. The obligatory disclaimer. You heard mention that the slides and the recording will be available as long as they remain relevant. And what you'll see throughout these slides is that they do not remain that relevant for all that long. They continue to change. And just as recently as yesterday, maybe the day before, we've just received the new loan applications. So throughout these slides, you will see where items are crossed out and repeated or changed in red. And that's to indicate that there was a change. And the reason that the slides are issued this way is because your obligations change based on when you made decisions, when you made a loan, and when you started making payments with use of those funds. You can still apply for a Paycheck Protection Program loan. They're still out there. The deadline is June 30th, but many of the banks are saying that the deadline is June 27th because they want to get them through the process. There's still plenty of money out there. So if in fact you believe that you are eligible for one, you should go ahead and apply. But just recently, at the end of May, signed into law in June, was the Paycheck Protection Program Flexibility Act. And that act expanded greatly the ability for borrowers to make use of the funds. The Paycheck Protection Program is designed to provide capital to small businesses, right? The idea is to keep businesses afloat. Initially, there was $349 billion, which then became $659 billion. And the CARES Act modified existing programs from the Small Business Administration loan section. They already existed. The Flexibility Act then changed the covered loan period to end on December 31st. And what does that mean? That means that that is the period, the covered loan period is the period over which you may use the funds. And it doesn't mean that you may use them during the whole period. You have choices to make, which you'll see a little bit later. The loans are available from certain Small Business Administration and U.S. Treasury approved banks. That list of banks has expanded greatly. For the most part, we have found that small businesses do better when they borrow from the smaller banks. Some of the larger banks have struggled. Some say they struggled because they gave priority to larger customers, and others say they just struggled. The loans are all guaranteed, and there are no prepayment penalties. So if you as the borrower want to pay back the loan for any reason immediately, there's no prepayment penalty. And the lenders get a pretty good deal here. They earn anywhere from 5% to 1%. I know that's backwards. 1 to 5% of the total loan amount in exchange for lending and servicing. The requirements are that the business and the entity must have been in operation on February 15th of 2020. There's a very small group out there that were just getting ready to open that did not qualify. All small businesses, all tribal concerns, only 501c3 nonprofits. They may have added C6 recently, but they must have less than 500 employees, sole proprietors, self-employed individuals, and independent contractors are eligible to borrow. Any business with less than 500 employees per physical location, and this is mostly in the restaurant industry, is eligible, even if they have an accumulated more than 500 employees over multiple locations. The balance of the loan is the lesser of $10 million or 2.5 months of your payroll costs. And your payroll costs include, your payroll costs are those that were established in 2019, unless you weren't in business in 2019. And it includes all of wages, tips, vacation, leave, group health benefits, etc. And it's the gross amount of your employee's compensation. Employee and owner compensation over $100,000 cash compensation is not includable. And owner compensation is included in partnerships. You can include up to 100,000, and in S corporations, you can only include the W-2 wages for the owners. The employer portion of the payroll taxes are not included, and any employee that's outside the U.S. is not included. If you had to pay out sick and family leave, for which you get a credit, and that is under the Families First Coronavirus Response Act that established extended sick leave. Those wages are not eligible. There are a number of other costs that you can include as payments. So this is what you can use the money for. You can pay interest payments on your mortgage obligation, and your mortgage obligations, and this is semantics, this is Congress using old language. They called them mortgage obligations on real or personal property. It doesn't include the principal payments, but it also includes like equipment leases and all loans that are secured by some type of property. Rent payments on real or personal property, and they must be under a rent agreement established before 2/15 of 2020, and utilities for which service was established before 2/15/2020. A number of people and businesses have changed their service providers for internet and cell phone, mostly because the service was not robust enough to keep their business going. We believe that you should use these when you look at forgiveness, but please be transparent. If you've changed, you should include bills from your prior provider and your current provider. And if you had to boost your service, you should include that so that you have the opportunity to have it forgiven. The bank and the SBA will make the determination about forgiveness, but if you don't ask, you never get a yes. Okay? There are additional modifications related to the Flexibility Act. So it increased the minimum loan term from 2 years to 5 years, and it retained the 10-year maximum. But this is for new loans only. If your loan was in place before June 5th, when this was signed into law, you have the ability to negotiate with the bank for these terms or any terms in between up to this term limit. And mostly the banks are going to agree because it's no skin off their back. And borrowers who receive loan forgiveness, the repayment period for any amount that's not forgiven begins on the date that your loan is forgiven or that you're notified that your loan is forgiven. That means there are no payments until you go through the whole process of forgiveness. And for those that don't seek forgiveness, that repayment period does not begin until the end of your covered period plus 10 months. Likely that is October of 2021. And it also allowed borrowers to continue to defer employer payroll taxes even after the loan is forgiven. Previously, PPP borrowers were entitled to defer the employer portion of payroll taxes and it was refundable, but only until such time as they learn that their loan has been forgiven. This allows borrowers to continue to defer the employer payroll tax even after the loan is forgiven. That is a deferral that allows you to defer until the end of 2021 for 50% of the employer payroll tax and to the end of 2022 for the other 50% of the payroll tax. If the PPP loan is used for its intended purposes, the first 8 or 24 weeks worth of all allowable costs will be forgiven. And it is 8 or 24. It's not 10, it's not 12, it's not 20. Current guidance from the IRS is going to disallow expenses associated with the amount forgiven. So if you have a $100,000 loan and you have a $100,000 loan forgiven, that $100,000 is not income to you when it's forgiven. But currently the IRS says they will disallow the expenses, which ultimately makes it taxable income because it reduced your expense. There are a number of initiatives working their way through Congress that will change that. That guidance is, the IRS hands are tied, and they had to provide that guidance because that's the way the Internal Revenue Code reads. Congress will have to act in order to change that. And it's quite possible that will happen because current guidance is that, or current understanding is that the intention was that it would be forgiven and would not be taxable. Previously, there were indications that 75%, or actually there was statute that said 75% of the total loan proceeds must be used for payroll costs in order for anything to be forgiven. The Flexibility Act changed that to 60%. And even though the Flexibility Act says that 60% of the loan proceeds shall be used for payroll costs, Treasury Secretary Mnuchin provided guidance, and the rules provided guidance that there would be prorated forgiveness available. So for example, in that $100,000 loan, if you use $50,000 for payroll costs, then you would not have full loan forgiveness. Your rental and other costs would be limited based on that 50% that you used. And allowable costs still need to be paid or incurred during the chosen covered period. So now you get to choose your covered period, 8 or 24 weeks. And borrowers that had loans in place before June 5th have the choice between 8 and 24 weeks. Borrowers that got loans after have 24 weeks. And the date of disbursement of the borrower's PPP loan is the beginning of the covered period. If in fact there were 2 disbursements, and there might be 2 because the guidance was unclear with respect to the fact that you could include partners in a partnerships application. So some partnerships, those that did not include it, were eligible to go back, and still may be, and increase their borrowing to cover up to 2.5 months of the partner's income, as based on 2019 numbers. You also have the option to have your covered period start on the first day of the first payroll cycle in the covered period. So they call that the alternative payroll covered period. And this is only eligible for employers who have biweekly, so every 2 weeks, or more frequent payroll. If you have multiple payroll methods or multiple payroll periods, you have a group of people that are weekly and a group that are monthly, it's not eligible. Okay. I have a handy dandy little colored slide here that tries to walk us through. Let's assume that we are funded on April 26th, and that is the first day of the yellow pay period. And we have a payroll date in that 2-week pay period. You can include the gray pay period, the gray payroll, all the way through to the pink payroll if you choose the payments during the covered period. If you choose incurred during the covered period and paid on the next regular payroll date, you can include the yellow period through the blue period, because yellow, green, peach, and blue are all during your covered period. For purposes of this diagram, I only used an 8-week period because I couldn't fit 24 weeks on a slide and have it legible. There are opinions out there that you can include both paid and incurred during the period and paid in the next regular payroll cycle. We're not really sure that we agree with this, but as I said previously, if you don't ask, you never get a yes. And so if you include both of those periods in your forgiveness application, we recommend that you make it quite clear that you've included both. Salary, wages, commissions, hazard pay, bonuses, all payments made during the covered period are eligible. They just can't exceed the annualized compensation of $100,000. And when the 8 weeks was expanded to 24 weeks, it became curious, but Treasury and the Small Business Administration have come out and said, yes, if you use the 24-week period, that annualized amount is $46,154 for all employees and employees only. They did increase for owners the maximum that you could include in forgiveness to $20,833. And that is 2.5 months of 2019. If 2019 was $100,000, if it was not $100,000, you would merely use 2.5 months of 2018.
Harriet?
Yes, ma'am.
So maybe you'll get to this, but there's a question in the chat here about 8 weeks versus 24 weeks. So you made the point that it had to be one or the other. There's nothing in between. But what if someone needed 12 weeks to fully use the available funds, or 13 weeks or whatever? What are the implications of choosing 8 versus 24?
Okay, that's a really good question. You don't have to choose until you apply for loan forgiveness, which is great. And so if you need that time to use the funds, you're going to have to remember that you're going to have to meet certain other benchmarks in order to be eligible for full forgiveness. So we recommend that you calculate your forgiveness at the 8-week period, decide whether or not you can live with or it's acceptable that you have that level of loan forgiveness, but you don't have to apply yet. You can wait until the end of the 24-week period, see what your business situation is, see how much relief you will be eligible for then, and then you just apply based on the better answer. But we do recommend that you do the analysis at the end of 8 weeks so that you know what you might be looking at should you not meet or have to lay off in the latter 24 weeks. Also, we do not recommend that you apply for loan forgiveness before the end of the covered period because the rules keep changing. And if you miss a boat and you apply for forgiveness and a better opportunity comes up, then you may have missed it. And these are the reductions. We're just coming up on the reductions that will affect your decision. Loan forgiveness is subject to reductions if you have a reduction in the number of employees or full-time equivalents as compared to the same period in 2019, and if there's a reduction in total employee salary or wages during the covered period that's in excess of 25% of their salary or wages during your base period. Reduction for full-time employees, you have to look, you have two choices, and you have to look and decide whether your average number of full-time employees per month from 2015-19 through 6/30-19, or the average number of full-time employees per month from January 1, 2020 through February 29, 2020. It's an average. You can use the real method or you can use the simplified method. The real method tells you that you take all of your employees, that are 40 hours or over. Initially, the SBA said 30, now they say 40, and they are one full-time equivalent. Even if they work 60 or 80, they're still one full-time equivalent. And then you take the remainder of your employees' hours, total them up, divide by 40, and that gives you the number of full-time employees that you would add to your 40 plus employees. The alternative method is for each employee, you apply 1 for all employees who work 40 hours or more, and you apply 0.5 for all employees that work less than 40. So why might you choose one or the other? On the left-hand side, you'll see full-on employees working many hours, and my full-time employee equivalent, if I use actual, is 19 hours. And if I use the method of the simplified method, I have 17 and a half. In my example on the right-hand side, I had to cut hours. And so using the actual hours, I come up with 15. But if I use the simplified method, I come up with 17.5. So we encourage you to use it to do the calculation both ways. In this example, we would recommend using the simplified method, of course, because you're at the same place. Forgiveness is also reduced by the total reduction in salary during the 8 or 24-week period. Employees and owners that earned $100,000 or more in 2019 are excluded from this calculation. So they are referred to as not protected. Employees that earned less than $100,000 in 2019 or were not employed in 2019 are generally considered protected employees. And by protected, what the SBA is saying is you still need to pay them. You need to pay them a reasonable wage. You'll get a haircut or a reduction in forgiveness based on the amount that exceeds a 25% reduction. If you rehire laid off workers or replenish your employee's salary by June 30, 2020 or December 31, 2020, you won't be penalized for having a smaller workforce at the beginning of the period. That doesn't mean that on June 30, 2020 or December 31, 2020, you pay everybody for that day a full salary. They're still going to look at an average. And there are numerous exceptions to the full-time equivalent. And I'm going to move a little bit faster here. Borrowers that document their inability to rehire employees. So if you offer an employee a job at the same level that they had before and they don't come back or they won't come back, you need to tell unemployment that, and you need to document it, and you don't have to identify them as a reduced employee. If your inability, if you can't ramp up to full because of CDC, Health and Human Services, or OSHA standards, and we believe that includes governor's orders, by the end of your covered period, you also get an exception. They're being very liberal. And in order to apply for forgiveness, the lenders are going to require the application to include a good deal of documentation. The applications will be online. Most, if not all of the banks will be doing this online. And you will have to provide documentation verifying everything. You've got the number of employees on payroll, pay rates, etc. For the most part, you can get this from your payroll provider, from your unemployment insurance filings, from your payroll reports. You will need documentation for your mortgages, for all of your interest obligations, and certifications. So each business will need a certification that all of the information is true. You will have to represent that everything was used to pay eligible costs, that all applicable reductions were due to the FTEs were reasonable, and you'll have to be able to provide proof. For those employees that won't come back because they make more on unemployment, the SBA has said they want you to offer them a position in writing. You have to attest that you've not included payroll costs in excess or non-payroll costs in excess of 40% of the forgiveness amount, and that the compensation for self-employed individuals doesn't exceed $28.33. It says here it's unclear whether or not the $28.33 applies to the S-Corp shareholder, but remember the S-Corp shareholder is wages. And again, be transparent. And you want to be transparent because you have to sign off on all of these representations, right? You understand that if they're used for unauthorized uses, there's criminal and civil charges available. You know that you verified everything, you've submitted all the required documentation. The information is true and correct in all material respects. And this is why we want you to disclose anything that is a gray area at the time that you make the application. The IRS has established, criminal investigations is establishing a group that is going after mostly the larger companies, but that will be auditing the use of the funds when the SBA raises the flag to them. So as long as you are transparent, we believe that you will have met your due diligence requirement. You have to attest that the tax documents that you provide, because you're going to have to provide the tax documents to the bank, and you understand that additional information may be required. So they have the right to come back and ask you questions. They have announced, they being the Small Business Administration, that they will be auditing all loans in excess of $2 million or $2 million and above, and that applies to an affiliated group of companies. So that means that the entire group together, if it's $2 million, you will be audited by the Small Business Administration. If you're below $2 million, that does not promise you that you will not. They still have the right, and you need to retain all of your documentation for 6 years after your loan has been forgiven. Some of the required documents I talked about briefly. You should maintain all of these documents, all of your calculations in one place, and you should be collecting them now so that you have them on hand, A, when it's time for forgiveness, and B, in case you're audited, because it's really hard to put this stuff together 6 years from now. It also helps make you feel more confident in signing the attestations that you have included all of the appropriate documents. To show the FTE, the documentation is at the election of the borrower. So the average number of FTE on payroll per month, you don't forget you get to choose your period, and you have to use the same period for your benchmark or your reference periods as you do, I'm sorry, the same method, not the same period, as you do in your covered period. You can't use the alternate method or the simplified method in your current period and the actual method in your reference periods. For all non-payroll expenses, you need to have copies of the statements or proof. You have to have supportable proof that these were in place at the time, at February 15th, and that they were still in place during your covered period. One item that is a big concern is related party leases. And the SBA and Treasury, no one has discussed related party leases, but they have identified that you must have a copy of your current lease agreement. And a lot of times we see in related party leases, we see that there is not a current lease agreement, but they will accept lessor statements from February 2020 and the covered period. For your business utilities, we talked a little bit about that before. What you want to do is you want to make sure that you have copies pre and post your covered period. If you changed providers, they may or may not allow you to have those costs forgiven. But again, if you simply replaced an existing service provider, they might. So you should include that. You should always include everything, you know, ask for the world and you'll get the best. Salary and wage deduction, you need to do this on Schedule A in the forgiveness application, and it is on an employee by employee basis. You have to address each employee, and salary and wages is not total compensation. Salary and wages is an annual salary, someone who is not an hourly employee, and wages is hourly wages. So if Fred earned $100 an hour pre-COVID and worked 50 hours a week, and he earned $100 an hour post-COVID and he worked 25 hours a week, he has not had a salary reduction. If he had a salary reduction of $50, which is more than 25%, then $25 an hour is what would be the base of your reduction. So remember, it's hourly wage or salary, not total compensation. Make sure that you have documentation for FTE reductions. Make sure that you can fire for cause. That's an exception. That's allowable. Employees that won't come back, that's allowable. However, they might disallow it if you did not notify unemployment, if they're collecting unemployment. Voluntary resignations are allowable. And a written request from an employee for a reduced work schedule, if they ask you for a reduced work schedule, have them ask you in writing. And then all records must be kept for 6 years from the date of forgiveness. Please make sure that you keep documentation supporting your certifications about why you needed the loan, about how you used the loan, and keep it for 6 years post-forgiveness. Because the IRS and the SBA are eligible to review these for at least 6 years. If they believe there was fraud, and I know I bring up fraud, I don't think any of you are in that position, but if they suspect it, they are eligible to look farther. So do your due diligence. These loans are very easy to have forgiven. As long as you have the documentation and you've used it for the appropriate purposes. You will likely have the vast majority, if not all, of your loans forgiven. And I'm pretty close to the end of my time, but do we have any additional questions?
There's none in the chat or in the Q&A function right now. This is a very comprehensive overview. There's a lot in here for sure. I'm curious, how are you working with your clients and just helping to assist them through this process? Let's say someone wanted to engage DeLap to help them through this. Is it easy enough to go it alone? Do you kind of give them enough to get them started and so they can do it themselves? Or, I mean, you probably have the full range, but I'm just curious.
We do. We have the full range of assistance available, except for the fact that we cannot complete the forgiveness applications on behalf of borrowers. The AICPA has provided guidance to us that we should not be doing that. We are there to answer questions. We're there to help you understand complex situations. It sounds easy to me when I talk about this because I'm knee deep in it every day. But as you heard, there are parts that I stumble through because there are so many moving parts that we don't expect anyone to understand it completely. You know, use your loan for payroll costs. Make sure that you rehire when you can, and when you can't, document why. And keep all of your records and evaluate the different ways that are available. And that's usually where we can be of most help, is we can look at what you've evaluated, what you've calculated, and tell you whether or not we think that you have followed the right calculation.
And as long as you're saving that documentation, is it sort of at that 8-week mark when you really first have to start evaluating, or are there things that you need to be looking at ahead of that 8-week mark?
Ahead of the 8-week mark, you kind of need to plan. If you are just getting a loan today, you have the opportunity to plan out 8 and 24 weeks. So you can model that out, and we can help you model it. We can't entirely model it for you, but we can help you model out what the best way is to return to full capacity and keep you moving and keep you paying your bills so that your business has the best chance of succeeding and existing beyond COVID. That part is not my expertise. That's Kyle and Dave, and I'm happy to connect anyone with them. There's a lot of thought that has to go through it. People consider whether they should pay employees to do nothing. Well, I don't really think they should do that. I'm sure there's a lot of things in your business that have been sitting idle and undone. And so if you need to bring employees back, there are things that they could do, maybe not their normal job, but things that the business needs to do. And I think we're right at 10 o'clock.
We are. So I'll close us down. I want to remind everyone that if you have further questions, you can email news@oregonbio.org, and we'll make sure that Harriet and her team get those, and we'll get those answered.
And the slides. The slides will go out.
And we'll make the slides available to everyone who registered this morning. Quick opportunity to thank our sponsors again, CAI, Nikon, Skanska, Summit Development Group, and VWR, and a special thank you to Harriet and DeLapp for sharing your wisdom with us this morning. It's a lot. We really appreciate it. Thank you for joining us today, and that ends our session. Take care, everyone.
Thank you.
Bye-bye.